welcome to the research desk.
In 2008, global financial markets were melting down. Historic investment banks were evaporating over the course of a single weekend.
The global credit system was completely freezing. Panic was absolute. So logically, if you were to measure the market's behavior in that exact moment, you would assume that randomness and uncertainty were spiking to all-time highs.
You would assume that total chaos equals maximum mathematical randomness. But you would be entirely wrong. It actually fell.
It fell. And today, we are exploring why that happened and what it tells us about the massive stakes currently facing investors.
Because between sweeping tariff uncertainty, the sheer gravity of artificial intelligence-driven crowding across every asset class,
Not to mention intense policy concentration and, profound geopolitical fractures, we are watching market narratives narrow in real time.
we really are. So to understand the mechanics behind this, we have to borrow a fundamental concept from information theory and thermodynamics, Shannon entropy.
In financial markets, Shannon entropy serves as a mathematical measure of uncertainty and informational distribution. When a market exhibits high entropy, it is a healthy, diffuse, and inherently unpredictable environment.
It is a rich mosaic of independent views. You have conflicting time horizons, disparate valuation models, all operating at once.
But when entropy falls, that state space shrinks. Low entropy implies extreme concentration. The market collapses around one narrative, one dominant flow, or one overriding policy regime.
And I know you look at this landscape and see a powerful diagnostic tool.
I do. The bull case for Shannon entropy as a trading signal is that low entropy reveals structural undercomputation by the market. It pinpoints exactly when investors stop processing reality efficiently and start acting mechanically.
It is the mathematical footprint of consensus without comprehension. I get the argument, but I stress test that exact premise from a completely different direction.
Let us hear the bear case then.
The bear case is that a clean measure of randomness is absolutely not a clean measure of mispricing. Relying on entropy as a signal involves a devastating category error. Markets do not move solely on statistical patterns.
They move on human behavior.
They move on semantics, incentives, real-world constraints, and reflexivity. Reflexivity being the phenomenon where a falling price actually alters the fundamental reality of the asset, causing the fundamentals to deteriorate simply because the price is deteriorating.
So you are saying entropy is just describing the crowd.
Low entropy might simply mean the market is highly liquid and efficiently digesting a well-understood macroeconomic regime. Or, far more dangerously, it might mean the market is gathering into a highly crowded, fragile trap.
Where any theoretical execution edge is instantly swallowed by slippage and latency.
Precisely. Entropy is a descriptive trap. It can perfectly describe the shape of the crowd right up until the moment that crowd runs you over. It masks profound structural fragility behind the illusion of statistical predictability.
To unpack that tension, we really have to establish what Shannon entropy actually measures in human terms. It is not a crystal ball for perfectly predicting the future. It is a tool for detecting when the cognitive diversity of the market has compressed.
In a pure Shannon sense, maximum entropy means maximum uncertainty. You have many possible states and no single dominant pattern.
If you look at an order book or a sector's pricing in a high entropy state, you see a debate. You see value investors buying cash flow, momentum traders chasing trends, macro funds hedging currency risk, and retail investors playing earnings surprises.
No single actor or narrative has total control over price formation.
But when that entropy metric drops, something structural is happening to the behavior of the participants. The state space shrinks. One force begins to dominate everything else.
That force can be panic. It can be a massive central bank intervention.
Or it can be a retail mania. Think of a monoculture narrative like the idea that artificial intelligence will fundamentally change the unit economics of every single business on Earth. When we see low entropy, we are seeing the collapse of informational diversity.
Participants have stopped actively processing new, disconfirming information.
They have outsourced their cognition to the prevailing narrative. When one narrative completely dominates, the market's pricing mechanism becomes mechanical rather than analytical. It is no longer weighing evidence, it is merely repeating a simplified story.
And you argue that mechanical repetition is what creates the mispricing? Because the underlying reality of the global economy is simply never as clean or binary as a low-entropy narrative suggests.
That is the core of it.
Well, I mean, the theoretical architecture of that argument is elegant, but the empirical reality requires a massive reversal of our basic intuition about how human beings and markets behave under stress.
Let us lay out what everyone universally assumes about financial panics. Logically, the assumption is that when a crisis hits, uncertainty explodes.
People assume that fear equals chaos, and chaos equals maximum randomness. If people are panicking, they are acting unpredictably. They are throwing out their models. Therefore, Shannon entropy should spike to its absolute maximum.
That is the consensus view of market structure during a crash.
So what actually happened? Think about this for a second. In a rigorous cross-country study of 43 national equity markets, Shannon entropy fell materially during both the 2008 financial crisis and the 2020 COVID crash.
It did not spike. It dropped.
The specific maximum decline across those 43 markets was around 4.6%.
That 4.6% decline is the exact data point that shatters the assumption that panic breeds randomness. We have to dwell on what a mathematically verified decline in entropy across 43 sovereign markets actually means for the underlying market structure.
It means that global markets stopped acting like chaotic, unpredictable systems and started acting like highly synchronized, deterministic machines.
What we're actually looking at in that data is the single trade crisis regime. During massive macroeconomic shocks, the market completely stops being that rich mosaic of views we discussed earlier.
It abandons all fundamental differentiation. It does not matter what a particular company's cash flow is, what their debt maturation schedule looks like, or what their long-term compound annual growth rate might be.
The entire ecosystem collapses into one mechanical, monolithic action. Sell risk, buy liquidity, wait for policy. Think about the physical rooms where these decisions were being made in March 2020.
Trading turned into a one-variable system. Every single asset on the board, from municipal bonds to technology equities to emerging market currencies, was being priced on exactly one axis.
The duration of global lockdowns versus the scale of fiscal rescue. That is low entropy. It is highly correlated, extremely orderly from a mathematical perspective, and completely terrifying.
But just because the market is acting in a highly correlated, predictable manner does not mean there is alpha there to be easily extracted. It simply means the market is temporarily operating under a singular overriding force field. It is describing the panic, not offering a roadmap out of it.
Yet that exact collapse into a single variable system is what sets up the most profound mispricings in financial history. The mispricing is driven by what we call the cognitive computation gap.
Tell me more about that.
To understand this mechanism, we have to look at the intersection of mathematics and human psychology. Consider the 16 6-bit computation gap. Let us walk through the math slowly.
I am following.
If a market event is a true black swan with a 1/64 probability of occurring, identifying it correctly before it happens requires 6 sequential binary questions. It requires 6 bits of processing power. Imagine you're a portfolio manager trying to navigate a complex macro environment.
You have to ask a chain of questions. Is inflation structurally sticky? Yes or no?
Will the central bank aggressively tighten monetary policy in response? Yes or no? Will that tightening break the credit markets? Yes or no?
Will fiscal authorities step in to backstop the damage? Yes or no? Is this a permanent structural shift or a temporary cyclical dip? Yes or no?
Does our specific sector have pricing power to survive the interim? Yes or no? You have to chain those analytical steps together perfectly to arrive at the correct probability. But human cognition, especially in times of mania or extreme stress, has severe biological and institutional limits.
Most investors stop after 2 or 3 questions. They experience cognitive fatigue.
They substitute rigorous computation for narrative shortcuts. They extrapolate recent price action. They stereotype entire asset classes. They undercompute.
We saw the ultimate manifestation of this undercomputation during the dot-com bubble. Let us set the scene of late 1999 to understand how informational diversity completely collapses in the real world.
You could read sell-side analyst notes, major financial media headlines, and corporate board presentations, and they all echoed the exact same simplified growth story.
The market had collapsed a remarkably messy, highly uncertain technological future into a simple binary. You were either an internet winner or you were an obsolete incumbent. The depth of the analysis stopped at the first or second bit of computation.
Does the internet change communication? Yes. Will this company grow its user base? Yes. They stopped asking the fourth, fifth, and sixth questions.
They stopped asking about unit economics. They stopped asking about capital intensity. They stopped asking about cash burn and the cost of acquiring those users. A company simply had to add .com to its name, and its valuation would soar, completely divorced from the reality of its non-existent profits or weak revenues.
The crowd justified this by actively claiming that traditional metrics no longer mattered. That is low narrative entropy in practice.
The numbers from that era tell the true story of what happens when a low entropy illusion shatters. The NASDAQ composite peaked on March 10, 2000, and subsequently fell roughly 78% by October 2002.
Think about the magnitude of that wealth destruction, a 78% decline across an entire major index.
The crowd was not wrong because they lacked access to information about these companies. The SEC filings were public. The cash burn rates were printed in black and white.
They were wrong because they stopped processing the information they had. They stopped spending the necessary bits of computation. When the market stops processing reality, the structure it builds is incredibly fragile. The 78% collapse is the ultimate testament to the danger of undercomputation.
The .com example is historically fascinating, but it perfectly illustrates my counterpoint. Entropy describes the fragility of that era beautifully in hindsight, but it offers zero implementation edge in real time.
How so?
Knowing that the market is undercomputing in 1998 or 1999 does not help you survive the margin calls when the bubble continues to inflate for another 18 months. Let us bring this into market microstructure to truly stress test your thesis about tradability.
I'm ready.
If we look at the subprime housing complex in 2007 and 2008, you could easily argue it was compressed tail certainty. It was a low entropy simplification of a fragile system.
The consensus narrative was uniformly aligned. Mortgages are adequately diversified geographically, collateralized debt obligations diffuse the risk perfectly, and national housing prices do not fall simultaneously.
But recognizing that the consensus narrative was a low entropy illusion did not tell you how to survive the negative carry of shorting those tranches for years before the break. Negative carry means you are bleeding capital every single month just to hold the position.
Timing is notoriously difficult, but the ultimate indictment of entropy as a timing tool is the flash crash on May 6, 2010. Let us look at the granular microstructure leading up to that exact day. We need to introduce the order book stability before break metaphor.
The glass bridge.
Think of the market environment at that moment like a vast glass bridge. If you were monitoring the order book through an entropy lens on May 5th, what you saw was apparent order. The market depth was increasingly dependent on highly predictable, machine-mediated liquidity. High-frequency algorithms were providing incredibly tight spreads and deep visible liquidity across thousands of equities. Statistically, it was a beautifully low entropy environment.
The glass bridge looked perfectly transparent. It looked architecturally sound. Traders were confidently walking across it, assuming the ground beneath them was solid because the statistical variance was so low. But a glass bridge is only stable until the exact millisecond a specific stress shock shatters it completely.
On May 6, 2010, that machine-mediated liquidity vanished instantly when a large algorithmic execution order triggered a cascade of automated withdrawals.
Stress test the tradability of that scenario. If your entropy model detected this abnormal, hyper-ordered state on May 5th, what was the actual trade you were supposed to put on? Do you short the liquidity providers?
Or do you buy prohibitively expensive crash protection that bleeds your portfolio every day the bridge does not break?
Do you simply exit the market entirely and incur the massive opportunity cost of missing the rally? A descriptive signal that highlights microstructure fragility offers absolutely no execution edge. The signal described the glass bridge perfectly. It mapped the molecular structure of the glass.
But it could not tell you when the specific footstep would fall that shattered it.
Nor could it protect you from the slippage and latency when the order book evaporated. Slippage is the vicious difference between the price you thought you were getting and the price you actually get when the crowd rushes the exit simultaneously. Latency is the delay in execution that ensures you are at the back of the line. You cannot trade a descriptor.
The challenge of timing is real, and the cost of carry is the death of many brilliant macro theses. But the critique that entropy is purely descriptive ignores that the most successful trades in financial history are precisely those that identify when a glass bridge has been built over a chasm.
In what way?
In the subprime crisis, the alpha did not come from merely noticing that the consensus was overly confident. It came from using that low entropy flag to locate exactly where the market was refusing to do the math.
The market was pricing a complex tail distribution, the risk of massive synchronized defaults, as a mathematical certainty of safety.
Investors who actually spent the 6 bits of processing power to read the underlying loan documentation were able to structure wildly asymmetrical trades. They did not need perfect timing because the magnitude of the mispricing, driven by that exact low entropy narrative simplification, was so vast that the eventual payout easily covered the excruciating cost of carry.
So you are saying the flag points you where to look, not when to jump.
The apparent order you describe in the microstructure is not a timing signal. You are definitely right about that. It is the diagnostic flag that tells fundamental analysts exactly where to focus their deep dive resources. It tells you where the market has stopped thinking.
But what happens when the underlying reality of the market is altered by physical, real-world forces that have absolutely nothing to do with market cognition or statistical processing? You are assuming that financial markets are closed systems of pure psychology and mathematics.
They are deeply human systems.
This brings us to the geopolitical trap, which reveals the devastating flaw in treating statistical stability as economic predictability. Markets move on physical constraints, supply lines, military interventions, and policy embargoes, not just the internal processing power of traders.
We can see the ultimate cautionary tale of this in the European natural gas shock of 2022.
Detail the environment prior to 2022. If you are running a sophisticated entropy model on European natural gas markets in the years leading up to the crisis, it would have shown an incredibly stable low entropy regime. The market was efficiently digesting a well-understood macroeconomic environment.
The pricing was perfectly shaped by established Russian supply patterns, highly predictable seasonal heating demand across the continent, and long-standing pipeline infrastructure.
The statistical time series data would have screamed that this was a durable, highly predictable system. The state space was incredibly narrow. Then the regime broke. Following Russia's invasion of Ukraine, the physical reality of the world changed overnight.
The pipelines were no longer just infrastructure. They were geopolitical weapons.
We saw prices violently surge from roughly 80 euros per megawatt hour to over 300 euros per megawatt hour within weeks. Any statistical model anchored in that pre-war low entropy calm would have mistaken temporary geopolitical order for durable predictability.
It would have sold volatility, assuming the market would remain calm.
It would have assumed mean reversion, betting that any price spike would quickly settle back to the historical average, and it would have been absolutely destroyed. The low entropy regime was not a hidden edge or a diagnostic tool for fundamental alpha. It was a trap.
This is the category error you mentioned at the very beginning of our discussion.
You cannot divorce statistics from semantics. Entropy cannot tell you whether the structure you are observing is fundamentally stable or whether it is highly vulnerable to an exogenous physical shock. When the external force field changes, when a war starts or a pandemic hits or a sovereign defaults, a low entropy regime flips into high entropy chaos instantaneously.
Relying on the statistical footprint without deeply understanding the physical and semantic reality of the underlying asset will inevitably lead investors to ruin. I completely agree that relying on statistics without semantics is a recipe for disaster, but that is precisely the synthesis we need to arrive at to make this framework functional.
How do you synthesize it?
Entropy models fail catastrophically when they only look at price narratives or statistical time series in total isolation. They fail when they assume the math is the territory. They succeed when they are paired with a valuation anchor,
A fundamental backstop.
the true underlying issue and the real opportunity for generation of alpha occurs when a compressed narrative completely severs the link between price and defensible mathematical fundamentals. Things like recurring cash flows, physical supply constraints, or tangible asset quality. Entropy is not the thesis, it is the triage system.
Give me an example of how that works in practice.
Consider a cultural example to illustrate the sociology of pricing and how consensus can detach from an anchor. There is a story of a family-owned sake brewery in rural Japan. For decades, it sold its product at very stable, modest prices to the local community, governed by the local economy and traditional consumption habits. Then, a prominent Tokyo critic visited, tasted the sake, and wrote a glowing article praising the brewery to a massive metropolitan audience. Almost overnight, the prices soared.
The old price was not statistically wrong, and the new price was not a simple, mechanical supply and demand update based on raw materials.
What shifted was the social consensus around value. The scope of the narrative expanded from a rural village to an international metropolis. This proves that a price can be statistically stable, exhibiting perfect low-entropy behavior, and still not reflect the valuation frame that will matter tomorrow when a new narrative arrives.
So how do you apply this sociological shift to an equity portfolio?
When we apply this exact dynamic to equities, the synthesis becomes incredibly clear. The magic is not in finding low entropy. The magic is in identifying high return on invested capital, low price-to-earnings businesses that are being completely ignored by a monoculture narrative.
Return on invested capital, or ROIC, simply measures how efficiently a company turns its capital into pure profit.
And the price-to-earnings ratio, or PE, measures how much the market is forcing you to pay for a single dollar of that profit. If you find a company generating a massive 15% ROIC, operating beautifully, but it is trading at an 8x PE ratio, while its similar peers with identical fundamental economics are trading at a 15x PE ratio, that is the perfect setup.
The signal here is not merely that the market has low entropy. The signal is low entropy plus anchor failure.
The market's narrowed attention, perhaps hyper-focused on a glamorous new technology sector or a specific macroeconomic fear, has caused it to completely ignore a durable, cash flow-producing engine. The real alpha lies in using entropy to locate exactly where the crowd's narrative has detached from the mathematical reality of valuation anchors.
Let us translate that theoretical synthesis into concrete portfolio implementation, because a transition from high-level philosophy to actual execution is where these models must survive contact with reality. The rulebook for applying this framework today is highly specific, and it requires strict adherence to quantitative parameters to avoid the very traps I have outlined. The numbers matter immensely.
First, let us look at narrative shorts. The protocol dictates allocating exactly 3% of the portfolio to quantitative strategies focusing on narrative shifts in retail-heavy tech sectors.
We're talking specifically about areas like AI infrastructure and quantum computing, evaluated strictly over a 12 to 18-month horizon. But there is a crucial, non-negotiable rule attached to this allocation. If the VIX falls below 12 for more than 3 consecutive weeks, you must cut that short exposure by half immediately.
The VIX is the market's fear gauge. It measures expected volatility based on options pricing. The logic here is brutal but necessary. Broad, low volatility, risk-on markets dilute stock-specific mispricing.
In a low VIX environment, the entire market is floating upward on passive flows and mechanical buying. Shorting a compressed narrative in an environment where fear is practically non-existent is suicidal, regardless of how fundamentally absurd the company's valuation might be.
Furthermore, you can overweight short exposure by 3% in extreme low-entropy meme stocks. Those are assets driven entirely by internet forums rather than fundamentals, but strictly over a 3 to 6 month window. This covers the specific period when sentiment inevitably begins to diversify, the crowd fractures, and the gravity of reality reasserts itself.
On the long side, targeting quality value, the mandate is to build a 7% long position in those high ROIC, low PE dividend aristocrats over the next 12 months. This is exactly the play on valuation anchor failure you described earlier.
You're buying the companies the market has forgotten because they are boring. However, the exit parameter is rigid. You do not hold these forever.
If the PE spread versus the S&P 500 narrows by 50%, you reduce the position back to market weight. You do not hold out for a complete perfect reversion to the mean. You take the profit once the narrative compression eases and the valuation gap closes by exactly half. The market rarely gives you perfect symmetry.
Just as important as those specific allocations are the strict rules for avoiding systematic traps. You mentioned the danger of relying purely on descriptive tools, and the implementation framework acknowledges this by requiring portfolio managers to underweight standalone entropy timing funds by 7% to 10% over the next 12 months.
You do not blindly hand capital to a black box that trades purely on statistical randomness. You only reassess that underweight position if the fund can demonstrate a highly transparent Sharpe ratio above 1.5 for 3 or more years, consistently achieved across diverse asset classes.
A Sharpe ratio measures risk-adjusted return, and holding it above 1.5 for 3 years proves the fund is actually generating alpha, not just getting lucky by riding a long-term bull market. Standalone entropy models are simply too fragile to trust without that empirical track record. Furthermore, to manage the macro instability, the exact geopolitical traps I highlighted with the European natural gas crisis, the portfolio must favor diversified 12-month trend-following strategies over static entropy models. And the volatility safeguard here is absolute.
If the VIX stays above 30 for more than 3 consecutive weeks, you must systematically cut those allocations from 7% down to 4%. A VIX above 30 indicates severe market distress and panic. In high volatility regimes, the raw noise of the market will overwhelm even the most robust regime signals. Statistical models break down when human beings are liquidating assets purely to meet margin calls. Capital preservation becomes the only paramount objective.
Finally, we must address the most speculative arenas currently operating: crypto and decentralized finance labs.
The framework treats these spaces not as core investable assets, but as pure laboratories for behavioral reflexes. They are the purest expression of raw human psychology meeting instantaneous algorithmic execution.
If you are deploying digital asset anomaly detection in these markets, you must cap the exposure at exactly 3%. You must strictly limit this capital to high volatility, low liquidity small caps.
We are defining that specifically as assets with market caps below $500 million and daily trading volumes below $10 million.
These are the opaque, deeply inefficient corners of the market where extreme undercomputation is rampant, where retail traders are making decisions on 1 or 2 bits of information. But the risk management trigger must be instantaneous.
You must reduce that exposure by 50% if the 7-day average Shannon Entropy rises above the 90th percentile of its history, or if trading volume rises more than 50% without price confirmation.
Either of those exact events signals that the inefficiency is fading, the crowd is waking up, the institutional algorithms are arriving, and the low entropy advantage you thought you had has completely evaporated.
As we look at the extreme specificity of those implementation rules, we converge toward a deeply shared understanding of both the immense power and the severe structural limits of information theory in modern finance. Shannon Entropy is definitively not a standalone alpha engine.
It is not a magic key that unlocks the market.
In fact, as we look forward into the next decade, artificial intelligence will likely kill any naive first-order entropy alpha. Any obvious reduction in price randomness, any predictable order persistence, or any simple sentiment compression will be identified, targeted, and harvested faster and cheaper by machine learning algorithms operating at the microsecond level.
The first-order edge, the easy trade of just spotting a crowded room, is gone forever.
However, AI will almost certainly create a massive second-order alpha by amplifying narrative feedback loops and exponentially increasing interaction complexity. Algorithms do not think independently, they optimize based on shared datasets.
They will herd together, compressing narratives even faster than human beings ever could and driving asset prices even further away from their underlying fundamental anchors.
Entropy's ultimate utility going forward is not as a timing mechanism to tell you exactly when to short the market, but as a sophisticated diagnostic tool to locate exactly where the global market has stopped thinking hard enough. It highlights the exact coordinates where the machines and the crowds have synchronized into a fragile, single-variable system.
It tells us exactly where the glass bridge is being built. That brings us to the fundamental, inescapable truth of market cognition. Human biology and algorithmic design share a common flaw under pressure.
Under extreme stress.
As the theory states, the market may be presented with a 6-bit problem and spend only 3 bits solving it. That cognitive exhaustion, that desperate reliance on simplistic, comforting narratives during times of macroeconomic stress or technological mania is the persistent flaw that creates true generational opportunity.
Entropy does not give us the answers, but it maps the geography of that exhaustion. It shows us where the crowd is absolutely certain and simultaneously utterly vulnerable.
To define this entire approach to markets, we have to recognize the core thesis of everything we have discussed. The real alpha was never in low entropy itself, it was in recognizing when everyone else mistakes compressed narratives for truth.
When the market confuses a beautifully simple story for the incredibly complex reality of global economics, the valuation anchors fail, and the structural mispricing is born.
As we look across the profound geopolitical fractures, the sweeping thematic manias, and the intense policy concentrations defining the landscape right now, the question you must ask yourself is this: where in today's market is a compressed narrative currently masking a fragile valuation anchor? This is the Research Desk officially signing off.